Greetings. My name is Ellen Baker. I'm the partner of Baker Aurora. We consult to family offices and introduce them to various alternatives. Much of what I do has to do with venture capital. And we have some panelists with us today, Nick Markola and Erica Duignan. And then John Cataldi will be dialing in also. And I thought first what I would do is ask everybody to introduce themselves. Then we'll talk a little bit about the outlook for today and tomorrow, some of the winners you've had, and what we can expect with the VC world going forward, thoughts on AI and so forth. So as long as I'm sitting next to Erica, would you like to begin and tell us a little bit about you and your business?
Yeah, thank you, Ellen. I would love to. So wonderful to meet everybody. Really thrilled to be here. And I've already had a chance to get to know a few folks while I was just waiting in the lunchroom. Great group. My name's Erica Duignan. I am co-founder and general partner at Rain Ventures. We are a $50 million seed stage fund that invests in companies in consumer tech and B2B enterprise software. I'm based here in New York. My co-GP is based in Miami, but we invest in companies all over the country and really sort of have a pretty diverse portfolio geographically at this point. One of the things, that's really interesting about my background, I've spent a 25-year career in finance, the first 8 years in investment banking, and actually started doing early stage venture capital here in New York City in 2006. So I've really been part of building this ecosystem, watching it grow here in the city, and seeing a lot of the ways that our tech ecosystem has changed because I've mainly spent my career investing in technology companies. So thrilled to chat with you guys today and tell you a little bit about the state of the market from our perspective.
Mark, Nick, would you like to introduce yourself and tell us a little bit about your background in business?
Thank you very much. Great to be here. My apologies, I could not be in person in the city, but I promise next time I'll do my best to be there. I had a last minute change, but in the venue, the way Arthur presented himself earlier, I'm also off the boat from Eastern Europe, not Poland, from former Yugoslavia. I've been in the US for 30 plus years. Early in my career, spent many years at large banks, from Bank of America, then Citigroup, an investment bank called Town Weisel Partners. About 10 years or so spent in the multifamily office space working for a private bank running investments. And looking at
Hey, Nick, can you speak up? Nick, can you speak up?
Make it a little louder.
Okay, absolutely. Sorry about that. For about
Good.
10 years or so, I spent on the in the multifamily office side. And then in 2018, decided to sort of approach dual mandate. First is investing in assets for our family, including in the early stage companies. Then also got involved with a venture capital firm out of LA that focuses on early stage investing in technology with an enormous focus on space itself. So in a way, wear two hats. First is investing in the assets for the family, and at the same time involved with an early stage venture capital firm called Type One, where we do early stage investing focused on space. And happy to be here.
Space. Wow, that's exciting. Cutting edge. Erica, would you like to talk a little bit about the outlook for venture capital today as opposed to where it's been the past couple of years?
Yeah, so, it's been an interesting kind of 14 months, basically since last March when, things really started to crater. And by that, I mean March of 2022. We, I think in the industry had a sense that a pullback was coming because the industry had really grown to much larger than ever before and much faster than ever before during the pandemic. I work at the seed stage, so generally working with companies when they're taking in their sort of first institutional round, which is generally around $3 to $5 million in capital. So there's not as much that can happen as far as market manipulation and dislocation at that stage. Where we really saw a lot of the sort of issues build up over the years with valuations, et cetera, is that all of a sudden, we went from an industry of a few billion dollars to an industry of several $100 billion in the span of, less than a decade. So much capital kind of had to be deployed into later stage rounds. And as more capital is deployed, valuations have sort of been pushed up to insane levels. That's why we saw the birth of so many new unicorns, every couple of months, because literally you had massive venture funds that, were keen to deploy anywhere from $100 to $2 million per deal, which sort of like necessitates making a company that maybe only even has, a couple $1 million in revenue, priced at $1 billion valuation. So March really, created the end of all of that, right? Because all of a sudden, with the decline in the public markets, there were so many, public companies with tons of revenue that were cheap, that were more interesting alternatives. It took a very long time for sort of venture capital marks to catch up with the public market, which, happens almost instantaneously. For us, it takes a couple quarters to accurately reflect valuations. And so, that is why we saw really kind of a standstill in investment over the last year, right? So the inability for LPs, because of the denominator effect, to commit capital to new funds, the need for existing funds to really preserve their capital for their existing portfolio and support their portfolio. And so we just didn't see a lot of transactions happening and a lot of kind of distressed rounds happening and a lot of companies with high cash burn going out of business, even if, they had raised at $1 billion just a year ago. So I think that, what happened over the last year is one of the things that makes our industry so interesting, is that, things can kind of go from 0 to 100 and 100 back to 0 very, very fast because there is a lot of risk in the asset class that we work with. The good news is that, my sense from, our capital deployment pace and also the interest that we're seeing from LPs is that things seem to be turning the corner a bit. People are motivated to actually get deals done, to deploy capital. There is a lot of dry powder. And it seems like LPs are also like peeking their heads back out from, around the corner to look at potential investment opportunities. The sectors that we've seen continue to be strong as far as deal making. As everyone knows, AI, I would warn that, AI is a wonderful technology. And, we've seen with the OpenAI platform and their API that this is going to be used to create a lot of really interesting new products. But I would warn people that, that we might be in a little bit of a bubble scenario as far as AI investing, because it's really the only sector, over the last year that has really gotten significant investment or had interest. So we've seen AI and we've seen data. So anyways, that would be, I know I want to give everyone else a chance to talk, but that would be a little bit of the update.
Great, thank you, Erica. John, I'm glad you joined us. Would you first introduce yourself and tell us a little about you and your company?
I'm supposed to be so good at technology and I can't seem to operate Zoom or their updates or terms of service. So I apologize. And I actually appreciate everybody's time and patience. This is my second time having the opportunity to talk in front of such a distinguished group of people. About myself, in a past life, I was the CEO for the Seminole Tribe of Florida. Most people know them for Hard Rock hotels, casinos. What they don't know is the other 49 businesses plus that by which they operate. I've been working in tribal domicile for a little bit north of 15 years. And we developed the first Native American venture fund to bridge the gap between what tribes could do from sovereignty, meaning the specialized set of laws that only tribes could do. For example, they can't be sued unless you want them to be. There's tax aspects. There's the ability to have 30% of all government contracting into perpetuity based upon your ability to deliver upon those contracts. And so when I was with the Seminoles, I was able to take some of these small business units that were mundane and nobody's ever heard of to add $1 billion, $2 billion to the top line. So the Seminoles are, by the way, an incredibly blessed tribe, an amazing experience. I left the Seminoles and with this venture fund and decided to work with tribes that have 22 people living per single wide trailer, didn't have a pot to, excuse my phrase, piss in, and that something like changing the dynamics from casinos or tobacco or other vice businesses to things of an acquisition we just did recently. CLIA Labs, post-pandemic, there's another one coming, but post-pandemic, and working on high tech, bringing in things that I believe my distinguished colleague, am I pronouncing it correctly, Panisha? The young woman to your left?
Erica?
Erica?
Excuse me, Erica, brought up with AI. We've been able to leverage AI, not in its current form of everybody loves Chat GPT, but taking the vast knowledge of the genome and visual coordination and manipulation of molecular and organic chemistries, and using a combination of AI and deep learning in a global research cadre to be able to take that information to look at new drug design, discovery, preemptive tests in cancer, and 101 plus other tests that we're launching out. So the future is bright, and what the pandemic has brought is a lot of opportunity going out of business. And what we're bringing to the table is a new set of laws and rules that we're going to be playing by on business to be able to capture that some mundane businesses and some very high level, high tech businesses and give them a rebirth under the tribal sovereignty umbrella. That's in a nutshell.
Hey, I just want to jump in 1 second here. And John, I worked, one of my first clients out of Wharton was Tribal Nation in Connecticut, which runs a very large casino. And so I love the Tribal Nation business. There used to be a group called Stark Investments. I don't know if you remember them, but they had a $300 million fund that invested in tribal businesses. And you're kind of the organic version of them at this point, right? You are looking at Tribal Nation businesses and seeing what makes sense from a venture point of view and other types of things that you take advantage of law.
Yes and no. We're actually taking businesses off the reservation. So in 2014, something amazing happened. The Supreme Court redefined the boundaries of a Native American tribe. So in 2014, the tribe said, you are not bound to the borders of your reservation. You're bound to wherever you have an economic interest within the domestic United States or any US territory, which means I could literally buy your building that you're sitting in right now, call it sovereign, and I would be exempt from ocean regulation. That's not a good thing, by the way. To taxation, to other stipulations that would allow me to run, in essence, my own embassy. So think of a tribe as a state, but having the same federal powers as the federal government, but not being annexed by state borders.
It's a country within a country. Got it.
It's considered a domestic sovereign. Yes.
Yes.
Hey, Marty, I just have one quick question for John.
I'm sorry, I got another question because it's your deep interest.
I don't mean to take over. No, I don't mean to be taking over the conversation. This is what happened last time.
Just a quick structural question. This is Rob. Do you require? Are you guys an active or passive? Meaning, do you require board seats by the tribe or someone native, or is it completely passive in terms of looking for a return?
Are you lead investor or co-investor?
We are primarily the lead investor. We are the creator of the business and business opportunity. So as an example, I just purchased 6 CLIA Labs that 3 years ago made 100 million, actually in 2000 and go back 2 years, 2020 made $100 million. 2021, they made 40 million. And after a lot of bad management decisions and private jets and celebrating all their awesomeness during the pandemic, they found themselves facing insolvency. But yet, they're on an amazing amount of equipment and materials and people. So we were able to take those businesses, reorganize them, put them within a tribal domicile. And by the time that we're done with this business, they will be most likely getting around $50 to $100 million. Let's call it $50 million in governmental contracts, probably this year, and roughly about $10 to $15 million in research grants.
And did you buy them for asset value? Did you buy them for asset value? What did you buy them for?
That's a whole other story upon itself. It's going to cost you a good glass of something or an NDA.
Okay, let's get back to the show.
Okay, Nick, back to you. Can you tell us a little bit about your thoughts on the outlook today and tomorrow, last few years, and what you foresee that you've learned from these past few years?
I think the venture capital space has changed a great deal. And I can't help myself. I come from a banking background. So if in the venture capital side, you should only think about the upside and never about the risk. But I can't help and bring my past baggage with me and think about the downside. I think the collapse of Silicon Valley Bank and Signature and Silvergate,
Yes.
I don't think that has played itself fully in the system, especially in early stage companies. I think the runway for the startups and technology companies got a lot longer than what it was prior to, let's say, last year or so. But some of the startups, you need 5 to 10 years of time horizon before you monetize them. And I know everyone's talking about AI, but let's ask ourselves, how many of us were discussing AI in 2018 or 2013, 5 or 10 years ago? So in reality, with the collapse of these banks, some of the funding that companies could rely on in the past before they either get acquired or hit the market is no longer there, which I think in return has brought some more normalcy to the market. Some of the valuations are actually more reasonable now than what we saw in the past. Some of the firms actually had to go and redo their capital raises at more reasonable levels. So I think the space is there. I would argue that venture capital is a phenomenal place to be in, but from an asset allocation standpoint, that's the amount of capital that you want the highest possible return on, but at the same time, you're taking the highest amount of risk, and you should have a time horizon of 5 to 10 years. Some of the liquidity that was there probably dried out, but slowdown in the markets or less capital does not mean there'll be less innovation. The US is still by far the number one place to innovate. And if you have a great idea, it's the number one place where you want to put that idea to work. So we still see opportunities in the space, but we're actually a lot more prudent with our capital because we need to make sure that the companies that we invest in are closer to that monetization aspect of it, they're closer to hitting the market or generating real revenues, or they'll need more capital to stay solvent, to stay in the game. So I think the environment has changed. I don't think people in the venture capital side fully understand the magnitude of the change versus how it was 5 or 10 years ago. Then when it comes to space, which is where we're focused, we still think that that's a very hot area. Everyone is chasing space. Thanks to Elon Musk, he's brought it to the forefront. But if you look at the numbers, in 2012 was only about $300 million that was invested in space based on some reports. And then 10 years later, 2021 or so, we had over $10 billion of fresh capital go into the space. So we still see opportunities in the space. We still believe it's the place to be, but we also tell investors that you have to buckle up. You have to be reasonable with expectations. You're not monetizing your investment in 3 to 6 years. You have to be patient, look at 5 to 10 years. And if you look at the real opportunities in the space, for example, very sizable addressable markets and near-term revenue potential, I mean, those are attractive ideas. The government has been very active in the space, so having a relationship with NASA or DoD is helpful, but in reality, that's not going to bring you to the finish line very successfully. So you have to look at the commercial aspect of your innovation. Whatever you're doing, you have to think outside the government funding and be able to tap into a commercial market to generate those revenues. And of course, I don't want to take all the time, but teams are extremely important. Betting on proven teams and proven expert folks that have been around the block. It's not their first rodeo, because space is a new market. We're creating something new, and in reality, we all use in space. Anyone that hopped in a plane, anyone that uses a cell phone, or uses the GPS in their vehicle, is not relying on innovation in space technology, and that's going to continue to impact our lives. So being able to kind of commercialize both from the government side and consumer side and generate those revenues for the companies, I think it's the way to go forward.
This is so interesting, Nick. I don't really know other folks other than Elon Musk or whatever that get involved in.
There's a lot in Los Angeles.
Oh, is there? Are there? Can you just expound upon maybe a couple of your winners in the space arena?
Well, it's still early because space takes obviously a long time to materialize, but we invested in the first gas station in space because we felt that in the past, satellites were built in such a fashion that you build a satellite for whatever purpose it was, just to sort of simplify it. Let's just say if you wanted to take high resolution pictures, you'll put high quality cameras, put the satellite together, fill it with fuel, blast into space. It will orbit around until the fuel ran out. Once the fuel ran out, the satellite was obsolete. Now, all of these satellites, imagine in the old days buying a car with one tank of gas. Once the tank of gas ran out, the car was worthless. So that was the technology in the past. Fast forward now, there's the opportunity to refuel in the space. And one of the costs is launch cost when it comes to space. And the heavier the item you bring into space, the more it costs you. So being able to launch a satellite or piece of equipment that's less heavy, so to speak, and refuel it in space makes a whole lot of sense. Another investment that we invested in, for example, gravity is an issue in space. We're talking about colonizing Mars and being in space, but it's still unknown what lack of gravity does to human bodies. The expectations there is fairly negative. So there's a company that we invested that actually creates artificial gravity in the space, allowing humans to live comfortably in space and create other international space stations in addition to the one that we currently have there. Next things, for example, radiation. The amount of radiation in space is also very damaging. So being able to tap into that market and then provide that protection through some innovation that in radiation space is another idea that we have invested in. So yeah, Elon Musk has put all this in the forefront, and obviously has been a huge driver of space, but there's a lot of people like myself that believe in this space, but knowing that it will take quite some time before some of these ideas are fully materialized. Lower orbit seems to be the lowest hanging fruit, where a lot of companies are gunning for and going after currently, but it's getting very crowded, and the upside isn't fully there. So you sort of have to pick your spot where you invest and what you're doing with the capital.
Hey, Nick, we have one more question, but I actually have one question I want to ask you, which is that there's a corollary, or there's adjacent areas also. I mean, it's not just space, it's a material science revolution, right?
Yeah, so one of the sort of worst kept secrets, the reason why Musk and Bezos and Branson and all these guys are looking to space, it has to do with precisely what you described, materials, and the value of those materials is in trillions and trillions of dollars of value if you bring it to Earth. So that's enormous upside. The other part is manufacturing space. For example, on Earth, our temperatures are between -20 to +120 degrees or so. But in space, depending on how close to the sun you are, you can be in an environment where there's no gravity, there's no impurities, and the temperatures are a lot more extreme. Plus, metals and materials mesh together differently. So yes, materials is one aspect of it. Production and manufacturing is another component that supposedly will be very lucrative.
Great.
One more question.
I've heard from two people who are extremely close to Mike Milken and Elon Musk. He says they're interested in the science, but the real thought is that they think in 30, 40 years, they probably can't live on Earth. And so they want to live up there. How soon can that occur? And what do you think of what I just said?
Short answer is we don't know, but Musk famously said he wants to die on Mars, but not landing. So he anticipates to go there.
Great.
Time horizon to look in 2026 is when Mars and Earth are at the closest point. So if we manage to get humans on Mars by 2026, will be an enormous accomplishment. Personally, again, if my risk management hat on, I don't think we'll get there. But 2024 is another point where Mars and Earth are a relatively close distance, not as close as 2026. So we may see some equipment, unmanned equipment, land on Mars in 2024. So dates to look for is 2024 and 2026. If we land humans in Mars by 2026, then to inhabit Mars will be very, very soon. If we don't, then we're probably looking at 20, 30 years out.
Great. Thank you, Nick. I'm going to switch to Erica. Can you tell us a little bit about some of your winners that are interesting?
Yeah, sure. So we don't really invest in frontier tech, like putting people on Mars. I think it's an interesting conversation, but honestly, like Mars is far less sort of hospitable of a climate than even Earth probably in 30 years. So I don't really, see how we're getting a trade up there. But I love that there is so much innovation on the space side, and particularly within materials, we've seen a lot of that. but we don't invest in it. We invest in things that we understand and things that we know, and really just applied technology here on Earth. So if I look at our portfolio, which is about half consumer tech, half enterprise software, we've seen winners in our AI companies. We have 2 companies in the space, one that's in legal tech, that's done really, really well, and actually has garnered a lot of attention from competitors and large sort of software companies. In fact, she has clients like Microsoft buying her software. So, you know, when Microsoft buys your software, you're doing something right, which is really exciting. But I would say that the biggest winner in our portfolio has actually been the most counterintuitive. In fact, it was a company I was a little bit resistant to invest in because they are in consumer products, but they've grown the fastest of really any investment I've ever made. And they are producing a breakfast beverage that is infused with functional mushrooms. For those of you who follow neuroscience, there's a lot of science coming out about how functional mushrooms, and that's chaga, lion's mane, cordyceps, are incredible at driving and preserving brain health. So they offer 2 beverages, a coffee that's infused with functional mushrooms and a matcha that's infused with functional mushrooms. And you'd think that this would be pretty simple for a $30, bag of a breakfast beverage. It's shocking that they've grown from around 12 million in annual revenue when we first invested 7 months ago to over 180 million in annual revenue within 7 months. So, I was telling somebody here that even if they had done 10 times worse than how they've actually done, I actually would have been like, wow, they've done great. So I think what it shows is that, those categories are massive and growing really quickly. And they are looking not to sell the company to one of the bigger CPG players, but to really become the dominant superfoods brand in the world. So we're behind them on that.
Great. Okay, John, would you like to share with us some of your winners or a couple
I'm
of
going to go with something completely stupid and simple. So one of the biggest challenges that
That's the best kind.
I know. I love when I was way back in the military, they had a little axiom: keep it simple, stupid, or KISS mentality.
Kiss.
But this is the future of lab diagnostics, and this, in essence. Whereas one time you'd have to draw blood or take a bowel sample to check for prostate cancer, or a blood sample to check for, a variety of cancers or neurological conditions, or even ADHD or depression. We've taken all of the tests, which are about 101 of them that we have earmarked right now. That is blood, sputum, fecal, what have you. And we've turned it into saliva. So putting this in your mouth for roughly about 90 seconds, a light indicator will go off. You'll squeeze this down into a compression tube, and this goes into an overnight FedEx envelope. The next day, it's at the lab, and the lab runs the sample, and it's reimbursed by insurance. Some of the cancer tests, are reimbursed for most Medicare, Medicaid, what have you. Our cost is, let's call it $60 for the test itself, and the reimbursement by insurance about $800. So there's a nice delta between there, which truly enjoys and loves. Now, the great thing about the test, and going back to and we call things AI or machine learning, what have you, but in essence, back in 2018, we call it deep learning or semantic latent indexing. Things have changed, but using computers to be able to assemble tests and to gather research and to be able to make it functional, actionable data has allowed us to go from a 2-year research process down to a 45-day research process. And because of our tribal umbrella, being able to go through the FDA and Center for Medicare Medicaid process from a 2-year process for clearance down to a 45-day for performance-based testing, another 6 days for usability testing. So less than 2 months and a few months having a commercially viable product for a specific test. And then we get into—
I'm sorry, John, did you say that you have like an accelerated process and you go like to the front of the line? So like a 2-year process takes 2 months?
2-year process takes about 90 days. That's correct. And that's because the tribal and also the CLIA regulations, because we're a high complexity lab, and the fact that we have intergovernmental affairs officers on a tribal basis in every branch of business. So we have a lot of.
Plus you get insurance reimbursement.
Sir?
You get insurance reimbursement.
The insurance reimbursement, that's accreditation with the insurance companies like Aetna, Blue Cross, Blue Shield, what have you. That process usually takes anywhere from 120 days to 6 months. However, on the tribal or it's closed. However, we're considered a minority, and because tribes are also on Obamacare, and that we're considered a quasi-government entity, they can't close out taking our qualification with the insurance company. So as long as we do the test, we pass through all the regulatory hurdles, we could get into the insurance network within roughly 120 some odd days, which is normally half the time of what it would take, if at all allowed for another lab or medical provider.
Hey, John?
Yes,
I
sir.
work with the Seneca Indians up near Buffalo.
I love the Seneca Indians. They are the most entrepreneurial individuals that I know, especially the Canadians.
Little do
And the Buffalo
people
birds.
know is that they're not a reservation. They're original owners of that land on the border between Canada and the US.
I just said that, yes.
I wanted to put some medical tourism there that would not be subject to the FDA. You know, the biggest problem we ran into, every time a chief changed, their whole policies changed. It
That's
was
the
every 2
problem.
years.
That is the problem. So you need to do a wrap around, like the Hard Rock Hotel and Casino. It survived 15 changeovers of management thus far. That's because they earmarked it and put it aside and put enough barriers around it. And Jim Allen was a very smart man for doing this, to not allow a change of management. And that's how our fund initially failed. We talk about risk. Doing projects on the reservation when you have a change of regime and they literally kick you off the reservation or keep you on the reservation. It's its own country unto itself.
Sounds like that island show.
It really, if Duck Dynasty can meet the Kardashians and have a reality show, that would have been the Seminole tribes and a handful of other tribes. But it was an absolutely amazing experience. And Seneca got their start in bootlegging between Canada and the US, and then cigarettes. Did very, very
Makes
well.
sense. And we had a question.
In terms of the family offices and some of these endowments institutions, last year public markets, both equity and fixed income, major downturn. So they were, if you look at allocation.
No,
point
I
of view,
think it's
they
Florida.
were over-allocated to liquid,
I think so.
you know, the LPs and private equities. Have you
Okay.
seen any changes in terms of the secondary market for venture capital, the secondary shares and funds and that space from your point of view? Is that something that people are looking from a liquidity point of view is moving
It's a
that
good
direction,
question.
despite what's happened this person?
That's kind of a Nick Markola question, which is mark to market venture assets and secondary market. I don't know if you guys see anything there, but I think Nick probably is the best person to answer.
Oh,
that
sure.
Yeah, I'm sorry, can you just paraphrase the question because there's some noise in between? I didn't.
Yeah. So the question, it's Steve is asking the question about, Steve McCarthy is asking about the mark to market of venture assets.
And has there been a movement in the
Secondary.
for liquidity because the public markets downturn last year mixed the asset allocation from private.
Right, so publics are down.
Institutions saying, am I over allocated to liquids? How to get out?
Well, publics are down from portfolio, it's your portfolio manager. From a portfolio point of view, publics have been marked down, privates haven't, you're over allocated to privates. Right, and so,
Secondary.
and then how are you seeing people work into that in secondary? Because it's actually a huge issue with venture capital right now. They
Right.
can't raise money because everybody's over allocated to venture. So you want to talk about that, Nick?
Yeah, briefly.
And Eric?
Yeah, there's no clear data on that because obviously private funds don't fully report on this. They're not. It's not daily transparency or so, but yeah, it's an issue, and obviously it comes to the forefront when these companies need to do the next round, and you know exactly where they are being valued and so forth, and that then you need to mark it down to whatever the next round is, if there's a down round. But unfortunately, I think a lot of VCs are still coasting and keeping the valuations where they did the previous one, and not reflecting where the markets are currently. Although I don't have any scientific data to prove one way or the other, but human nature is such that we tend to report good news immediately, but bad news we kind of hold off as long as we possibly can. So I think it's an issue with the industry that we may see some regulation. We may see some regulation where they decide to tackle again the tax aspect of the carry business that they've discussed in the past. But for now, it is an issue. I think a lot of funds are carrying some of the investments where they did the last round, but not necessarily where those companies are currently at, unless the companies have gone out of business. When the company goes out of business, then obviously there's nowhere to hide. But if
Right.
the companies are still there, it's an issue.
Or have you seen a pickup in secondary?
And
So,
Erica, yeah.
so I would say on the whole, most funds that are audited, you have to mark your portfolio to market after a year. So that has really sort of, I think, trickled down that, people have been forced, they can't just say, oh, well, the last valuation was, $1 billion, so we're keeping it that way. What I've seen is that we are getting opportunities for, secondary market positions that are, maybe priced at like a 20th of where the last round was done. So there is a dramatic lack of liquidity. There are people who have funds that, they need to get out, right? Or they need to create some sort of exit opportunity. So I would say there are probably a lot of great opportunities to pick up equity, but the market is not strong right now. So, it's a good opportunity.
I've seen, and we just did not a down round, but we had some losers on the tribal side. And I hate losers, just in general. I mean, but one way that I've seen myself do it, and actually came out of a conversation with another fund manager, is we had personal holdings within that company. And so what myself and several other of the GPs ended up doing was saying, you know what, let me go ahead and bring your debt or what have you, or your equity, what have you, as a conversion from a principal who had a big chunk of the equity into the another entity, and allow you to buy in at a reduced rate than the Eggers listing. You wouldn't have the same taxable. There's some tax loopholes to finesse there. I leave it to much smarter people than myself. But that seemed to do two things. One, exit bad investments, and two, not so great, unhappy investors or people that weren't seeing return year over year as the other assets were appreciating greatly, into a new friendly investor. Plus, I believe there's a karmatic thing that happens when you look out for your investors and bring them along into a new project as well, especially if you have a winner here. And I'm really sorry you put all that money in over here, but we're going to just, swim in this pile of cash. There's just, I'm big on the whole karmatic give back to those that help get us to where we need to be.
That was that sort of brought us to the whole point of the challenges and opportunities. So we know that there've been some bank failures that are close to the VC market, and also that the markets have been down. So we've had a lot of challenges. What in particular do you see going forward as to how to overcome all this, or how do you march forward in your particular style? John, you just spoke. Nick, do you want to jump in?
Sure. So yeah, I touched upon the failures of the banks. I'm not going to repeat that. And I think once the companies closest to public markets, they'll have to have the cash on hand. The line of credit would not be there probably the way it was in the past. But I think going forward, the focus is on good teams, whether it's on the VC side, the venture capital firm that you're investing in, someone who's been around the block and has the access, has the ability to look at the proper investments. If you're doing direct investments in the company, same thing. Look at proven teams, folks that have invested, that have an entrepreneurial experience, that have some wins under their belt. You want to bet on those, because I don't mean to be negative on this call, but think about Frank and JP Morgan. They have an army of people. They did their due diligence and they still had Adam on their face for that Frank investment.
Right.
couple of days ago. We saw Junco raise what, 30 or 40 million dollars, and still some great funds were involved with it, and it happened. So unfortunately, we're in markets where there's not a lot of public information, so it's a lot harder to do their due diligence. So you have to rely on people that you've built relationships in the past, like whether it's John or Eric or someone else. You need to call and say, what do you know about XYZ company? What do you know about John Doe and Jane Doe, the founders, and do as much due diligence in the background. If you can do that on your own, great, by all means do it. If not, team up with venture capital firms that have been around the block, that folks have contacts in the industry, and they can do that due diligence. But I think lack of information, lack of transparency was there in the past. It will continue to be there. Now you can't really fake it until you make it, because there's going to be less capital going forward. So companies need to rely on the capital to deploy it very efficiently and really get to the finish line and add value to the investments. As John pointed out, we all hate losers. We're trying to avoid as many losers as possible and just focus on winners.
So, yeah, just slightly jumping to a different topic, but similar. I thought maybe what we could do is talk a little bit about how you source your deals, and Erica, do you want to jump in on that?
Yeah, sure. So that's a great question. My partner and I, have been investing together for a little bit over 10 years, and I've been in the venture capital industry for about 17 years now. So really the way that we source deals is, coming and speaking at things like this, right? Going to speak at conferences where founders are, building relationships with accelerators and with other VC firms that maybe invest a little bit earlier than we do, or a little bit later. So when they see things that aren't quite ready for them, we get a call. In fact, a great story of how I sourced the company that I talked about that's, had the amazing growth was that we were actually leading around for another company in completely different sector, enterprise technology. And one of the co-investors in that round said to us, hey, we had such a great time working with you. We'd love to make an introduction to this founder and see if you want to come on the cast, strategic investor. So for us, it's really about relationships, networks, and really just like investing that time and energy to really be available for founders, so that after they have a conversation with us, whether they get a check or not, they're coming away with enough value that they're going to recommend us to other great founders.
That's a good point. So John, do you want to jump in and share with us how you source some of your deals?
I would say that I look for the mundane, the overly regulated, the things that could easily be commercialized if there was just the removal of X amount of red tape. And I'm very good at being a cat herder of people. I surround myself with people that are much brighter than myself. So I guess that my official title is cat herder. And it really comes down to reputation. Everything that comes into sourcing, I look for those that have been successful in the past, or those that have been part of teams that have been successful. And I don't mind rolling the dice on somebody that has amazing passion, insight, and heart versus a Harvard, Stanford, MBA, because if they could bring together a solid team, a good product, or something that's ready to be commercialized in the market, that's where my interest really gets excited, especially if you could take something that's being used for one purpose off the shelf, maybe a government or a corporation forgot about it, and very easily, and that's how we the first saliva, COVID, and flu test, repurpose it for something completely different, and be able to bring it to market quickly. That's beyond exciting, and that just takes being in networks just like this and surrounding yourself in new networks and new venues every day to increase your breadth and depth of experience and network.
Interesting. And Nick, do you have anything to jump in
Yeah,
here?
I'm not going to be redundant. Of course, accelerators or universities, combinators, we all have all that access to it, and going to conferences. We have a team that is much younger than I am, and they love to fly, so they travel the world. But it goes down to what John said: it's the reputation. Being in space and being the crazies out there who focus in space, we kind of build a reputation. And we found out that current investors that we invested in, the supporter are probably a great source of referrals because they know who else is moving, who else is looking to build something else, where's the competition, and we get some great deal sourcing from actually current companies or the companies that we have looked at in the past. One of the benefits of venture capitalists is most of the firms are nimble, small, that can move pretty quickly, but also be able to deliver, in addition to capital, other resources to these startups, and having their reputation say, hey, if we go with the XYZ fund, in addition to funding, they'll also be able to bring us their network and their experts in the space. Kind of sets you apart, and that's what we found out in the past, to be able to find quality deals to look at and quality startups to look into.
Good, good. And Erica, I noticed that you've got a lot of very interesting LPs in your fund. And it seems to me that it's sort of like almost club investing. You know, I've done something great, and I know somebody else who has, and so I'm going to share it with. Has that been your experience?
Yeah, so our LP base is mainly institutional, but at the same time, you know, those institutions all talk to each other and are kind of clubby. So, you know, our largest LP is the Metropolitan Museum of Art, but we were introduced to them by our second largest LP, which is Russ Carson's family office. So, you know, we do have a lot of family offices that all know each other. But on the individual side, like most of our investors are folks who have either started their own private equity or venture capital firms, and that we can learn from, you know, as we make investment decisions and grow.
Is this a fund 1 or fund 2?
So we're 2 years into the investment period on fund 1, and we're looking to raise a fund 2 early next year.
And John, I know we're getting close to the end, but I wanted to touch on, are most of your investors from the Native American world, or?
Absolutely not. Most of our investors are family offices, high net worth investors, endowments. So we have a lot of, when we go into a new sector, we like to gravitate towards strategic investors to help us not just bring capital to the table, because you always have dumb capital. That's not hard to raise. But to generate capital that also generates business and good board members and other influencers of your fund, I think is paramount.
Hey, John, quick question. Have you ever thought of doing creating a compound pharmacy on a Native American reservation? Because, you know, 25% of all pharmaceutical products in the United States come from compound pharmacies, right? I don't know if you know that.
I have 5 pharmaceutical licenses, and I would never do anything on the reservation when you have the same sovereignty and less red tape off the reservation.
Well, okay, so under a tribal aegis, like I'll just say under a tribal aegis. Have you ever considered that?
There's so many things that could be done, and you know, here's an example. There's a law that prevents only the original manufacturers of the pharmaceutical company to re-import their drugs. And that's why at one point an EpiPen cost $600. A venture capital fund bought them, and they said it went from $40 to $60, even though epinephrine costs you 50 cents a vial. Under tribal regimes, unless it's been by law, there are no restrictions. So compounding, yes, but also the importation of other drugs into the U.S. is a whole other avenue to keep healthcare. You know, the next gen of healthcare is going to be lower pharmaceutical prices, cheaper equipment, and better care, and potentially as robotics and technology come into play, it's going to become incredibly interesting. But what I'm saying comes with an asterisk, because lots of people have tried compounding pharmacies and other businesses, both on and off the reservations. If you don't understand how sovereign law works and how it could cut both ways, you're going to, it almost be like going to China saying, I'm going to be an importer, and not having any experience in ever working, you know, in the Asia Pacific or China. You're going to get your ass handed to you. So there's that too.
Yeah, interesting. And now we have a question from Rob.
Thank you, Ellen. It's Rob Collier. Nick, to further space guy, you know our portfolio company Bradford Space in Europe, but I guess more to the people in the room with Erica. Can you speak a little bit about going it alone, or whether you prefer to be part of a small syndicate or a large syndicate? And if the others want to chime in if there's time.
Yeah, so we always have co-investors in the deals that we lead. We will take a board seat and sort of be responsible for protecting the interests of the entire investor class. But we think it's really important that, the companies that we're investing in have also gotten buy-in from, other firms that see the vision, understand it, and are willing to support them. It's a little bit of a test for us because it's not just whether or not, we have conviction in the investment, but it shows us that this person has enough capability at fundraising that they're going to be able to raise subsequent Series A, Series B, et cetera.
And Nick, you were going to jump in a little bit about your, because we hit everybody else with regard to their types of investors.
Sure. So quick answer to Rob's question. We actually prefer smaller syndicates, and we typically go in very early. What we look for in the founders that they're flexible or amendable, and typically if it's a much larger group, they tend to be a little more difficult to be flexible. So our preference will be some nimbler, smaller groups, but it's not written in stone. And in terms of our investors are usually crazies like ourselves that still believe in space, and mostly family office or high net worth individuals for now. And as I mentioned a few times, we tend to go pretty early, in some cases pre-seed or seed, and Series A. So there has to be an enormous appetite for risk taking to do what we do. So
Yeah, for sure. Well, thank you, everybody. I think we're now moving on to the next topic.